All right, this is going to be recorded, and one thing I say at the beginning of all of these webinars is if you're not familiar with options or you're just starting to get familiar with them, learning these, watch this again relatively soon after getting it. We're going to send this out to you guys and try and watch it again because it'll refresh everything. It'll put it into your long-term memory, and you'll be able to understand it a little bit better because some of the nuances might fly by you the first time. You're thinking about questions to ask and might miss something. And when it goes back through the second time, you will really be able to understand this a lot better. I am confident. This is the options workshop on covered calls. One thing I'll get out of the way real quick is this is actually the strategy that got me into trading, really. I went basically from investing to kind of trading in a sense, not really beknownst to me. I started trading in college, and then with some money I had earned, talked to some people. The guy that was working at the bank was a discount broker and told me about these options and how I could cover some of my stocks that I was complaining about not really working. Believe it or not, it was IBM and Walmart were the two that I really started implementing this strategy with back in the early 90s. So this is really what got me into managing my portfolio on a daily basis and ultimately got me to move to Chicago. Hey Trevor, how you doing? All right, so let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now. And like I mentioned, I started trading in college, and I started out by buying stocks and was looking at building a portfolio. And I became a trader when I started doing this exact strategy, and that was using covered calls against those long stocks to collect a little bit more premium, increase my yield, and didn't really realize it at the time because I was not even in finance. I was going to school for psychology, but I was lowering my basis and increasing my probability of profit all at the same time. So that's the beauty in this strategy. Anyway, throughout that time, from college all the way to moving to Chicago Board of Trade after graduating with a finance degree, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. So I've traded pretty much through it all. Got to get this disclaimer really quick. It says any opinions, news, research, and analysis or other information contained here or any material provided by ProTrader Strategies and associate companies or employees is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these things that we're talking about, whether it's securities or strategies. And the reason why I can't do that, you guys, is I don't know your risk parameters. I don't know what's in your portfolios. And what I could be doing could be counterintuitive to what you are already doing, for one. The other thing is it just isn't fiduciary responsibility for me to do something like that. So take what we teach you in here. We're here to teach you how to swim, not really to swim for you. And I'm going to be talking about probably some stocks or strategies that I already have in my account. It's not trying to get you guys to jump off the cliff with me. It's really just to teach you how to manage your own portfolio. And bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. Another thing, I'm on Twitter. You can follow me at Wolfman's blog, and you can follow us at ProTrader Strategies for market commentary and other market snark, if you will. So this is going to be increasing your gains using covered calls. Now the beauty in this, one of the major things that I took away from this, I mentioned that I started doing this with IBM and Walmart. I was watching IBM trade up to like 103, 105, in the early 90s, and then it would go right back down to like 95, and it just kept bouncing above and below this 100 mark. It really wasn't going anywhere. Walmart was doing the same thing. I think it was right around 45, maybe trade up to 50 and then come back off again. Well, I mentioned this to this discount broker, and he was like, why don't you start selling some covered calls against it? You know, if it goes up to that 105, then you basically sell out of it. And if you think it's, you know, goes back down to 95, you reinvest again and get in and out. You know, I mean, he might have been looking at it from the brokerage aspect, but at the end of the day, it was a strategy that was really working out. And if it didn't go up to that 105, I got to collect that premium. So I just looked at it like, this is the beauty and this strategy is I could get out at a level that I wanted to be, or that I was comfortable at getting out of that particular stock. And if it didn't go there and it kind of traded sideways, then I got to keep that premium. You know, ultimately with this strategy, it's a bull strategy. So we want it to go up and hit our calls. That's what we want. We don't want it necessarily to trade sideways because we don't make any money that way. I mean, we make a little bit off those calls that we're selling, but you know, at the end of the day, it's not a bad thing to have those this strategy go through our short calls. You've made money. It's kind of like you ask yourself if you'd rather have unlimited profitability, or would you rather have an increased probability of profit? Because with a stock, we're looking at it where the probability of profit, if you just buy that stock, is 50-50. I mean, we can see that in the options chain when I pull it up. Those options at the money are a 50 delta. And if you watched any of my videos on trader hacks and stuff like that, well, you can take that delta and determine what your probability of that strike being in the money at expiration, and it says 50. So that tells you that buying the stock at that at the money strike is a 50-50 probability, and the probabilities of buying stock is random because the stock can go up and come down. But if we sell a call against it, where we're doing is we're lowering our cost basis on that, and we can show you on the probabilities, you're going to, just one time, the first time you sell that call against it, you've increased your probability of profit by doing that covered call to about 65%. So yeah, you are limiting your upside potential from infinity, but we've seen stocks, they don't really go up that fast. So they do consistently go up, but we're going to try and create a strategy where we can increase our probability of profit and trade around it, lower our overall basis. You know, if you can do this several times out, you can dramatically reduce your cost basis on that, which ultimately increases your yield dramatically. So that's the beauty of this strategy. And it's great, especially if you're kind of trading in an IRA and you have stocks in there. This is an IRA appropriate strategy. The other thing is, if you're a newer trader and trying to get comfortable with trading options, this is a great strategy for that. All right, so why do we want to do covered calls? Like I mentioned, you could literally lower your cost basis, and you could probably even lower it to zero if you do this over a long period of time. Okay, John's mentioning, is it really 50-50? Depends on if you buy it like at a support level. Yes and no. I mean, you know, if you are a real technical trader and really believe in reading the tea leaves, then some people might say you could increase your probabilities in a sense. But if you are strictly looking at probabilities don't take into account that you're on a support level. It really is saying it doesn't matter where you are. It is 50-50. The problem I have had is I buy it for 50, say sell the 52 at the money. I think you're saying at the money, or a month out, sorry. And then it is expired 45, have to wait and go back up for it to sell a 47 call, then the risk being called out. Well, you know, I don't know how much you collected for that. So if you bought the stock at 50, you sold the 52 call, the stock goes down to 45. If you sold that 52 call, your break even is probably right around 47, right? So I probably would look to sell that 50 call then. So then if it goes back up to 50 where you bought it, you've actually collected that premium. So we'll talk about that also. I'm not sure if I answered that right, but back to John's question, you know, it is always, the probabilities are always going to be 50-50 when you're buying a stock. It doesn't matter if you're on a support or a trend line or anything like that. It's probabilities are probabilities, right? And the price could not otherwise be realized. So for instance, in our example of buying the stock at 50, if we sold, say, a 52 call or a 55 call, we're synthetically buying that stock below where it's currently trading. So if it continually went up, we bought it lower than you otherwise could have. And it's adjustable based on assumption. Now, what I mean by that is that if we start to turn into a bear market, then you can start getting tighter to at the money and collecting a little bit more premium. So if it's a stock that you like or you've had for a while, you know, and you think that it's due for a turnaround, maybe it's up against a resistance level, then you could sell just above there and be a little bit tighter. So, but if you think it's going to really kind of rally up, you want to go to a little bit higher delta, or lower delta, I should say, a little bit further out of the money. And it increases our profit when the stock alone wouldn't. So what I mean by that is if the stock is trading sideways, we've increased our profit by selling that call against it if it's just trending sideways and it doesn't really go anywhere for us. So you can always, you have the opportunity to increase your profit. Sometimes the premium seems too low. Absolutely, Dominic, and that is very true. So I will go into those guidelines as to what we're looking for. Yeah, if you're looking especially at like a $7 stock, right, your premiums for selling out of the money, you're going to be getting, you know, 10, 20 cents. So we don't want to do, it's not worth it. Our risk reward isn't worth it, right? Our risk for $10 or something like that, profit there, versus, you know, them getting bought out at $17 or something like that. That would be a case where we wouldn't want to always do it. There is going to be something that we need to look at for the risk reward. Yes, and Stuart, an email will be sent out with this playback for you, and watch it again for sure. And do you do weeklies or monthlies? I have a tendency to lean towards the monthlies. The markets are usually a little bit better in there. And when you start getting into the weeklies, it goes back to we're not really collecting enough premium for the risk that, you know, that we could be taking on for the upside. So it's going to be a bit of a balancing act, if you will, on that. And then some of the guidelines here, and I've switched these frames up from what I usually do just because this is a little bit of a different strategy around. You'll see they're pretty close to the other ones, but using shorter duration options, this goes back to RS's question, do you do monthlies or weeklies? I'm going to probably try and shoot inside of this here. You know, when I talk about other selling strategies, I'm out here around 45 days. But on this one, I'd like to get inside of this 35 days and really take advantage of this theta decay. Another thing with this strategy is I'm going to be covering it early. I'm not going to write it into the very end of the day for all the same reasons. I'm going to roll this strategy out well before here. So I'm not going to collect all of it. But the reason why is because hopefully the market's rallied up a little bit and I can roll this up and out in time, roll it up strike or a higher strike out in time and collect around that same premium. So we're going to be hopefully being able to ratchet these calls higher and higher and higher, and that lowers our overall basis that we paid for it originally and increases our upside potential. That would be the perfect scenario for this. But you know, anytime it rallies up and hits our short calls, that's a great scenario either also. And we can just reallocate that money somewhere else in another high probability trade, or when that market has a pullback, which all stocks have a pullback, that's when you would re-implement this strategy again, which is what I talked about doing with with my IBM and my Walmart. I just let those calls go through. Back in the day, I used to let those things expire worthless if it didn't come in. I've kind of rejiggered that. Plus, brokerage and everything else has gone so much lower now that we can trade online and things of that nature that that risk is no longer outweighed. So we're also going to be using the correct strike selection. Now, what does that mean? Well, you know, like I mentioned, in a bullish market, we're going to be using something like the 35 delta, or about a half a standard deviation out. If it's a bear market or it's a stock that just continuously starts to slide, we're going to probably be going closer to at the money. And one of the rules I use for like a bear market, when the market starts turning down, say for instance, like, you know, just with Lulu, you know, we saw this big pop in Lulu and it starts coming down, I'd probably be selling closer to at the money strikes for this one. If you guys have been paying attention to the daily market commentaries, you know I got bitten on the earnings here. I'm actually short Lululemon. I was short at 65, short the 65 calls, had that stock handed over to me, so I'm short the stock, and I sold the 65 puts. Same thing. It's the opposite trade, but you know, since I'm short stock, I sold the puts and we're right back down there. So I lowered my basis on it and we're trading right there. So it's like the perfect scenario for me. So these things do work out for you. And had it not come back in that time, then I would have just rolled those puts out, just like I talked about with these calls. So if you watch these daily market commentaries, you see me doing this stuff all the time. And I did it with Twitter when I had puts on and Twitter went against me and was given Twitter stock. I just started selling calls and actually became profitable on that by doing this exact strategy. So it works out. You can do it that way as well. Implement this strategy after something may have gone awry with a different strategy and you were handed that stock, or you were put that stock, or you are had to be short. Do you look at the market profile and base on that to do your covered call? Yeah, I use market profile quite a bit with those that strategy with Lulu. That strategy was so far against me. I was like, I would be happy to get out for a scratch, which is why I picked the 65 puts, because I was short Lulu at 65. I mean, it was trading 72 or something like that when I put those puts on. So, you know, the puts are going against me, but the stock has come in my direction, so it's worked out quite nice. So one last thing with strikes, or the correct strike selection, we want to pick that 35 delta, which is this half standard deviation away. And how you come up with that 35 delta, or the 30-ish delta, it's going to be about 31 as a half standard deviation away. So I'm right around there, somewhere right in that 32 to 35 delta. You just add up all these percentage probabilities and that comes up to about 31. So that's where we're looking for this one. In a bear market, we're going to be going a little bit closer, and I'd throw it out there, a 2% out of the money for bear market. So if it's trading $50, you know, you're going to be looking at the 2%. So it's going to be really close to at the money. All right, so yeah, you'd be doing like the 49 or 51 delta or something like, or 51 strike, something along those lines. Then be mindful of dividends and earnings. I don't like to do this covered. I'll let these covered calls if I've had the long strike. This goes back to your risk reward, right? You know, for instance, if I was long Lululemon going into that earnings, I wouldn't have been selling a covered call in that option cycle. So I usually skip out of that. And to answer RSs for weeklies and monthlies, I might go to the weekly on that type of scenario to make sure that those calls expired before that binary event, and not have it on for the binary event. It just isn't worth it for me. Earnings, I don't mind doing this around earnings. Basically what happens when they pay the dividend, or when they, sorry, I may have said that backwards. Around earnings, I'm not going to put this on. Around dividends, I don't mind selling a call around the dividend, because the dividend is going to lower your price of that stock by the dividend. So, you know, that will help us get in our direction a little bit. But for the earnings events, I'm going to let it ride and maybe go to a weekly where the weekly expires before that earnings event. I usually leave it clean for the earnings. Then, did that go to the same one? Sorry, guys. Choosing the right underline. For this one, we don't want to be doing something where, you know, they trade a lot of this stock, but there's just not a whole lot of open interest in the options. We need to have both. We need to have a lot of open interest in those options. Goes back to the same thing I say in all these webinars. If I'm looking at a stock that's $100 or less, the bid offer in the option montage needs to be inside of 10 cents. So we're going to be looking at something that's tighter than 10 cents for a stock that is under $100. Another thing I say is if you're playing with a stock that's over $100, you move that decimal points 3 ticks to the left. And if it's like so for instance, if it's a $300 stock, you move that decimal point 3 ticks to the left. The option montage should reflect a 30-cent wide bid ask. So our maximum profit on this is going to be that strike price minus the stock purchase price plus the premium. So that's going to end up being our overall profit. Why are we adding in the premium? Because that lowers our overall basis for this whole trade. All right, so the stock purchase price is our max loss is that stock purchase price minus the premium, because remember, we've lowered our basis. So on a $50 stock, if we collected a dollar premium, we synthetically own this at $49, but you know, it could go to zero. And then our break even is when the stock price, the current stock price, is trading equal to where we purchased that stock minus that premium. That's our break even. Does that make sense for everybody? Do you usually see covered calls every week? Do I trade covered calls every week? No, I usually don't. If the only time I'm anymore trading covered calls and you know, selling puts against short stock is when it's been put to me. And what I'm trying to do, yes, John, break even is equal to your cost basis. Absolutely. So this is when something's gone bad for me, when I've had a strangle on and it's kind of gone through my puts and I have the stock now. Then I'm going to immediately become mechanical and start selling these covered calls. I'll do this a lot in my IRA too, where I do have some stocks where I will throw covered calls on those as well. So do I usually sell, okay, I usually sell covered calls every week? I will sell covered calls in the monthlies generally if I have the long stock. And I usually go to the monthlies. I don't usually go to the weeklies. Michelle, did I answer your question there? What about small accounts? I've been taught to do it in low price stocks for small accounts. For example, someone with $10,000 account would be paying $5,000 on one contract of a $50 stock. Do you also buy a protective put? No, I don't buy a protective put, Avery, and the reason why is, especially if you're trading with lower price stocks, the put is really going to eat up the cost of that call you sold. I mean, I will do it every once in a while, but usually with the higher price stocks. If you're trading with a smaller account, I've done stuff on poor man's covered calls, and you should look at that one because you will not have to put out as much money as you would for stock. Your overall and your return on capital is much higher. So check out that webinar on poor man's covered call, because that poor man's covered calls are great because you're not spending nearly as much money as you would if you had stock. It's a really good webinar. So you start with selling a naked put. Generally, that's how I get my stock, yes, is from the naked put going against me. I do own stock in other accounts, and I will use this strategy around that a lot. But for the most part, this is the time I use this the most is when something has gone wrong and I'm becoming mechanical. I'm lowering my cost basis on it overall. Does that make sense? Does owning a leap and selling a shorter term call work better for capital usage? Yes, Stan, that's what I'm talking about. And it's called a poor man's covered call. I just recently done one on it. So you guys should check that out, especially for smaller accounts. I'd say under, especially under $10,000 for sure, but under 50,000 would even benefit from that because you can create a more diversified portfolio if you're using the leaps. For sure. All right. I lost $5,000 because the stock went bankrupt. If I had bought a put, I would have been okay. Yes, Avery, that's true. That's true, you would have. But at the end of the day, that's one of those few instances that's going to happen. That happens to all of us, and that's going to happen. Probabilities are that it's not going to happen that often. So in a sense, you could almost look at it like, well, that's happened to me now, and don't be afraid to get back up on the horse again. But my thing with buying the put is if it's a $17 stock or something like that, your risk to the downside isn't as great as to the upside. And another thing is if you watch that poor man's covered call webinar, that has a synthetic put in there, because when you're long the call and it goes down, then you already your risk coming into it because it has a synthetic put in it in a sense, because you're long the call rather than the outright stop. I love the poor woman's yes, covered call strategy. Do you have a webinar for that? Yes, we do, Michelle. So definitely check that out, especially for the smaller accounts for sure. Should be a link right there, and they threw you a link there for it, Michelle. You see that? Can I get a link to it? RS, you want a link to that also? Yeah. Confused. I can use this for long-term positions, or is it you're covering today is only for the positions you've temporarily acquired? Well, both, Dominic. So when I first got into this strategy, it was, Pat, you don't see a link? I don't know. They might be able to add that link for everybody. I don't know. because there's a lot of people asking for it. And you know what, when we're talking about this at the very end of the class, you guys might be able to get access to it there too. So, what was confused about the positions? So Dominic, so if a lot of people like to buy stocks and have a portfolio of stocks, right? I used to have a big portfolio of stocks, but now I've kind of switched over and slowly gone over to options trading. So for me, a lot of times the only stocks that I really own, especially in my margin account, are the ones where I've had naked strategies go against me. And this is a mechanical way to trade that position back into profitability. For instance, when I had the Twitter trade on, I was long Twitter at 25. I was able to lower over the course of probably 4 or 5 months, rolling calls out in time, out and down. I was able to lower my overall cost basis to under 20. I think it was like $18.50 by just selling calls against it. So that's pretty powerful. And I mean, Twitter was trading pretty low at that time too. I mean, it was trading below 18 or something like that. So I was still losing money, but I was able to lower that cost basis. I didn't have to hope and pray that it was going to come up. I was selling calls just above where my break even was on the stock and just waiting for it, you know, hope if it came up and hit my calls that I was short, then I was out of that trade, which is what I'm looking for, to be mechanical and overall increase my probability of profit, which is how I did that with Twitter. Now, if you have stocks already, this is still a great strategy to do that around, because our job as investors or traders, the greatest investors in life are not the ones that figure out which direction the markets are going. They're the ones that figure out how to reduce their cost basis rather than that directionality of it. They're the ones that know that when you buy a stock, it's a 50-50 probability, but they also know that stocks go up and down. We don't know exactly when they're going to go up and down all the time. So if you're always selling calls against it, when it goes up, if it clips you, you get out of that stock and you just wait for it to correct, and then you buy it back in. If you really love having stocks in a big portfolio of stocks. And that's what I was doing when I was in college and when I first moved up to Chicago, was I had a portfolio of stocks that I had built from almost nothing to a pretty nice portfolio by the time I graduated. And most of that money was generated because I was selling calls against stock I had owned at prices that I was willing to get out of. I just saw IBM always traded up to 100 and just kept coming back off, or up to 105 and would come back off down below 100, and I was getting in and out of it all the time. I.e. Facebook and its IPO price 39. So yeah, if you have Facebook at 39, I mean, and you consistently sell calls against that, then you know you could lower your overall cost basis to zero had you started that earlier. Eric, when you use leaps for covered calls, do you buy the deep in the money or at the money leap calls? Michelle, it's all explained in that webinar. I talk about how my idea is really with those to pay for the extrinsic value for that. But I don't have really enough time to go into all that. So, and Pat, I won't be able to click on your link. I don't know what your link is there. If I have something at a low cost basis compared to where it is currently, do I approach it differently or not? Dominic, I don't. I'm going to be looking to sell that 30, 35 delta call all day long. That is the idea, to have it taken away and not hold it. That's my idea. If you know, it is a winning problem if I sell that call and my stock runs up and gets called away from me. That's a win in my eyes. So I don't really care with this strategy if it gets called away from me. There's other stocks that have come off that I'd like to own. If this one's really rallied up, my thing is the probability is it's going to come back off. So I'll wait for it. You know, I got all day to wait for it to correct. There's something else out there that has already gotten beaten up, and I'm willing to catch it for them. And that's where I want to buy it, is when it's gotten beat up, and then I start selling my calls against it. And then when it gets up there and called away from me, I look for something else. Does that make sense? So here you go. So our return on investment is our max profit minus or divided by that basis. So the basis is the cost of that trade. So that's going to be your return on investment. It's your return on investment isn't going to be as good if you don't have that, or your return on investment could be better if you didn't sell that call against. I'm sorry, but the thing here is by reducing basis, we increase our probability of profit, which, like I said, would you rather have a 50-50 chance at unlimited profitability, or would you rather know what your max profit is, but increase your probability of success? It's kind of like if you're playing poker or something like that, would you rather have an 8 or a 9 or an ace? You know, the ace is 11. It could go to 1, but, you know, people will take that trade all day long, right? And the covered call is kind of like that ace in a sense. Oh, your internet is acting up? I can't do anything. I'm sorry about that. Oh, you lost the audio? Yeah, the best thing, if you guys ever lose audio, they say you kind of log off, log back on, and it should fix it. And that's another reason why we have it taped, is so if you think you missed anything, you could go back. And then your loss on investment is obviously your potential loss over the basis. So which your loss on investment is always going to be a better scenario than if you just bought it and lost it all. But here, enough of that, because we are going to have to rip through this. Does everybody pretty much think they've got the idea of this so far? So for instance, the reason why I think that this is so important right now is we're at historical highs, and the overall, like 52-week highs. Anytime the stock is trading at 52-week highs, this is when my spider sense, I guess, if you will, goes off, and it's like you have to be doing covered calls right now. We're just out of earnings season, so we got a lot of clean months ahead. I don't think Microsoft has, sorry for that, Microsoft has earnings coming up anytime soon, but actually they do. They have it coming up right after this. They have earnings right in here. So we would want to go to the shorter duration, which would be the these January calls, the 21 days. Plus these are the 49 days, and that's a little bit further out than what I really want to go for. So can you do a webinar on adjusting spreads? Absolutely. So the idea with this obviously is if you could just continually collect this premium. This is right around that 30. This would be a pick'em for you because it's right between that 30 and 35. This is a little bit closer and a little bit further away, because I think that I'm looking at the chart and I just see that it just made this 52-week high. It looks like it's rolling over a little bit, right? Could want to come back down and test this support here at 61. I would probably lean a little bit tighter. So I would lean to go to this one. So what I'm talking about, if we look at this right here, it's trading 62.14, right? We're looking at the delta, it's 52. That's, you know, if it was trading right at 60, exactly on the nose, we would have a delta of 50 here. And that delta is the probability of this strike being in the money at expiration by 1 penny. So we could say the probability of it being in the money or out of the money, meaning it could be below or above 62 even, is a 50-50 probability of profit. It's a 50% chance. Now, if we look at this, where we're going to be buying this stock at $62.14, but let's just pretend it's 62 for math purposes, and I sell this 63 call, which is about that 37 delta. I lower the basis of what I paid here by 60 cents. So if we look at the probabilities of 50 cents lower than that, right, because that's our break even, we've increased our probability of profit by 10 percentage points. I mean, anytime you can increase your probability of profit by 10 percentage points, I mean, would you take it? I sure would. I surely would. So in the sense that we could see this market come up and trade through our 63 calls, we'd made $1 on that trade and it got called away from us, plus the premium we originally collected. Because at expiration, this is all extrinsic value. We get to keep extrinsic value at expiration. Even the ones that are at the money. So these are going to be the ones here. You can see this, no days to go. There's no extrinsic value in these. 14 cents is where it's bid at. It's 62.14. So there's no extrinsic value left in those. So we would have gotten to keep all of that money. At expiration, that's all intrinsic value. That makes sense? So that's why we don't care if it goes up there. We collected that $1 to the upside. It's a trade. We collected the premium because it's all extrinsic. That's why it can't really, you're not going to make any more money once it goes above that, because it's all intrinsic value as it goes higher. But you get to keep that extrinsic value to the upside. So I would take that trade all day long. You know, when I was in college, I was selling them a little bit further out, but you know, I opted to go a little bit closer these days because I could care less if I'm holding on to that stock. Plus, I want the bigger premium. So, I mean, I'd take $1.65 all day long, right? In a month. That's a good trade. And then when you get a pullback, then that's when you would get out of it. With Microsoft being in a pretty bearish move, you know, you might go to the 1% or that, what did I say, the 2% out of the money, which is usually just right out of the money strike. What's 2% of, it's about 60 some odd cents. So that puts you right around there. Right? Does that make sense? Does anybody have any questions? Or it'd be $1, actually $1.20. Sorry, 1% would be $6. Yeah, 1% would be $6. Is that right? For some reason, I guess on Friday late, I'm having a brain fart. Yeah, 1% would be 60 cents on, so it'd be $1.20. So we'd look at the $1.20 one, which kind of putting us right there anyway. It'll work out better on some of the ones that are a little bit bigger. Does that make sense to everybody? So we're looking for this like 30 some odd delta strike for more bullish markets. We're going to be looking more at the money on the more bearish moves. Everybody got that? And I'm looking for inside of 35 days. So this is the one I would opt to. I don't want to really go that far out. Plus, this is going to have the earnings in there. If this had a dividend in it, I wouldn't care, because usually the stock is going to drop by that dividend they pay out, which will, in a sense, help me get some more of that theta decay coming out. The other reason why I don't want to sell out here in the ones that have an earnings cycle, volatility as it expands is going to hurt me. Even if the market doesn't move. So these premiums are going to go up in value if it stays completely sideways heading into that earnings event. As we can see here, heading into earnings events, volatility starts increasing for that particular earning event, and then it crushes right after. So I like to stay away from that. And this volatility is going to increase until they have that binary event. It's not going to affect the options montage that doesn't have that earnings event in it, though. But it's definitely going to hurt the ones that do. So if I were to sell a call in here and we continue to see this volatility increase, it could go straight sideways or even possibly continue down. I could get this market continuing down and still lose money on those options. I'd have to take it all the way through the earnings event, and it could blast up through me, and I wouldn't be happy. So I try and stay away from that. If the market goes bearish and you have been selling at the money calls and your strike goes in the money and it is below your cost, do you buy it back? That's a great question. I usually try to do it where I'm not selling below where my break even is. So for instance, if I bought it at 50 and I've continued sold it, and the market's trading 40, but I lowered my cost basis to 45, I'm probably going to stick there with those 45 calls for a while. And otherwise, I try not to do that, but if I have to, I look at it like, I'm cutting my losses. Yeah, I'm locking in a loss, but at the end of the day, we're doing this to make money, not lose money. So, sometimes you got to pull the ripcord on a losing trade, right? So I don't love to do that, and I try and avoid it as long as I can. But if you're not collecting any money for that strike, you kind of have to start ratcheting it down. You could go really far out in time, though, in that case, and collect a little bit more premium. You can always look at that. Maybe if you would have to look at 60, 90 days down the road in order to collect that kind of premium, that would be a better option than locking in a loss the way I look at it. Probably go right down to where my break even is, try and figure out that call further out in time so I could collect more theta decay. And then, if it came up to that 45 call, then I'm good with it. I've gotten out for a scratch plus whatever premium I sold in that particular month. Does that make sense, Fred? That would be a case where I would look for duration to collect more premium. What is the volume profile setting is weekly. I have a webinar on setting that all up too, you guys. So for you guys that are looking at the volume profile here, I have a whole webinar on how to set that up. I like to go for the longer duration with the volume profile rather than daily. I do look at the daily though for, say for instance, like the markets overall, and I show how to set up this also so it's not on the extension. And you'll actually get that with the deal we have going on, you guys, which you guys should take advantage of. This is the premium membership offer. It's 2 months for the price of one. You basically get access to over 50 online trading videos. You get my trading lessons, which are little shorter videos than these hour-long webinars. And you also get access to all those other webinars and shorter ones. Like the ones for the volume profile are a little bit shorter than the rest of these. So this is a great deal for all of that. You guys have been asking a lot about the poor man's covered or poor woman's for Michelle covered call. I also do poor man's covered put, poor woman's covered put in there as well, especially for you guys that have smaller accounts. I show you basically how to use options in lieu of stock, but sometimes we can't get away from having stock in our account. Also, if you're even trading like SPY and stuff like that, if your portfolio has gotten away from stocks and you're trying to match the overall market by using just SPY rather than building out a portfolio, then you can still lower your cost basis on that as well, which is a great way to increase your probability of profit. Just keep selling those calls, or if you're short something like you want to be bearish it, you can sell some puts against that. So it's a great strategy for that. And for the puts, if we're short something, I go through the same ideal where I'm going to that 30-ish delta put, and if stock was put to me, I usually will just sell that put where I'm short. Do not have to worry about earnings with the ETFs, correct. That's the beauty in that one. You can continually just sell it. John, Happy New Year to you. Thank you for joining us. I know you got to go. I'm getting really close to shutting this all down. But you guys, I mean, in these webinars, I talk about what we learned on the floor. And this is all to teach you how to trade like a floor trader. The best traders out there, I'm telling you, are the floor traders. For one, floor traders tell you exactly how it is. We all talk about our losers more than we talk about our winners. And the reason why is because those are the ones that are top of mind. We're all going to have losers, and those are the ones we need to stay mechanical, stay diligent with. And you guys might hear me talking about my losers a lot. And the reason why is because I think it's so important to manage those and turn those things into profit. That's the real win. You know, those quick hits come and go. That's great money. You're beating probabilities, but the ones that you end up spending most of your time with are the ones that have been a losing trade and turning those into winning trades, just like I did with that Lulu. You know, I could have cut my losses and just gotten out of that, but I stayed diligent, stayed mechanical, and I'm turning that one around. It's the same thing I did with Twitter earlier on in the year. Turned two of those massive losers into profitable trades by staying mechanical and doing just what I've talked about in this particular webinar here. So it's all of this stuff in this trading course is huge. The other thing is you guys have had a lot of questions, a lot of great questions. One thing you have with this is you get unlimited access to me. I have a no inbox policy for emails. If you guys reach out to me and have any kind of questions, I am going to get back with you. The offer is in the chat window. It's not going to pop up in the questions box. It'll be in the chat window. So go to that and click on the link there. That gives you this offer, and it gives you those access to all of those webinars. You also will get the daily market commentaries with this membership. So this is what I'm talking about every day. I talk about all my trades, when and where I got out of them, and if they've gone against me, how I've been mechanical and traded around those over the entire course. I keep you updated. I tell you exactly when I'm rolling, tell you exactly when I've taken losses, and I tell you exactly when I've taken my profits, and following those rules that I've talked about in all of these webinars. So you get that as well. Live trading. And no, they're actually recordings. We can't do it. I mean, I suppose we do the recordings because then people can watch them at their leisure. If you are one of the premium members, you will have access to the poor man's covered call and poor man's covered put, Avery, for sure. And if you have a smaller account, it's brilliant for that, for sure. Winning trade by adjusting or some other strategies. Trevor, I implement all kinds of different strategies on any given day, depending on what implied volatility is and everything else. So it's really kind of all based on that. Does that make sense? All right, so in later webinars, we're going to be drilling down on different options components, when and where I find them appropriate. Also, Please reach out to us at trading@protraderstrategies.com. If you guys want us to do a webinar on a particular strategy you haven't seen me cover or I haven't covered in a long time, reach out to us because I'll be happy to cover it. You can also contact us at 310-598-6677. This is the link to that premium subscription offer. You can type this in there. You can pause this right now and then, or when you're watching the recording, and punch that in to get this offer for watching this. Otherwise, the easiest way to do it is to go to that chat window and just click on that there. Avery, how long is this good for? We do it today, and then we've done it for the last 3 webinars, but if you watch this webinar, you're going to be able to get it. So, or if you've subscribed to this webinar, you can take advantage of that. So, but I don't know if it's going to be the same offer next week. We might come up with a new one. So take advantage of it for sure. It's a new year. We're going to be doing all kinds of different things this next year. So can you briefly look at these in terms of which are good candidates or bad for covered strategies? Yeah, we can click through a couple of them real quick. NVIDIA has been all over the place. I actually just did a strangle around NVIDIA. But NVIDIA is, okay, so, I mean, I'll tell you what my thoughts are on NVIDIA. I think NVIDIA is going to do really well. I think everybody was worried about, you know, at the beginning of the year, that the PC was dead, the tablet's going to take over, everybody's going to go to laptops. But I'm telling you, this younger generation, kids, you know, under probably 15 or even, you know, under 15 for sure, but even a little bit older than that, all of these kids are getting into these online games, and they're kind of pulling away from PlayStation and Nintendo from what I've seen. So a lot of these kids are going back to the PC because they're doing their gaming on those PCs, which is driving NVIDIA, Microsoft, Adobe, and stuff like that. So I am relatively bullish long-term NVIDIA. So this would probably be something I would have in my portfolio. This kind of market movement right here is a little bit wanky. They just got downgraded by somebody. So this would be a good one to look into it, because it could have a pullback. They're actually calling it to come back to like 90 something. So I would definitely, if I owned it, so you can see I've got the, oh, you can't see my strangle on that side, but I'm short here and short like the 90, 90, is it the 95 puts? So again, I'm not trying to get you to jump off the cliff with me because of my NVIDIA trade. Where is it? There it is, the 93s. So so I have a strangle on around there. But for that particular strategy, the beauty in this one is you're going to be able to collect a nice chunky premium by selling like the 30 delta is probably where I would go here. With the strangle, I use a little bit different strategies, but the 30 delta on this, you're basically buying this stock at 104.50. So you're buying it at 104.50, you're collecting $2.50, so that puts it at 94. You've increased your probability by 10 percentage points by doing that. Short seller on circling around NVIDIA. Well, there was I can't remember who the fund said that they were lowering their guidance on NVIDIA, and the IV percentile popped on it, so I took advantage of it by selling a strangle around it. That's why I did it that way. But long-term bullish for me in NVIDIA. So this would be something I'd probably do a poor man's covered put or something like that, or poor man's covered call around it, and you know, I'd be buying something like these 95 calls, which means I have no risk below 95. How about a webinar on adjusting long calls and debit spreads? Trevor, I don't adjust long calls or debit spreads. I will adjust credit spreads, but at the end of the day, on those limited risk ones, I don't usually adjust. So, because they're defined risk. This is one of the defined risk strategies that I will adjust, but a debit, I don't throw another debit at a losing debit trade. Do you sell that strangle? Yeah, I did sell the strangle. Actually, it was really against me yesterday because IV looked like it was starting to come out, and all the premium came back out of it today, so I'm close to break even on it. But that's the thing with selling option strategies. You know your probabilities when you get into it. You know, I knew my probabilities were in my favor getting into this, so you can keep your powder dry and let the probabilities play out. Option strategies always seem to, well, every strategy, I mean, even if you just buy a stock, it always seems to go against you. That's part of investing, is you initiate a strategy, it does have a tendency to go against you, but increase your probabilities of success with all of these strategies the way I've talked about it. I mean, that's the way I look at them, is playing the probabilities, and that allows you to be more mechanical about it rather than emotional. Try and take the emotion out of it. All right. Does that make sense? Kind of running out of time, so is that good enough, Dominic? For the cat, same thing with cat and GoPro. I'd probably be looking at selling right around that 30 delta. If you're a little bit more bullish in them, you know, lean towards the 30 delta. If you think it's going to go kind of sideways, or it's more in a bearish trend to the downside, then start looking at a little bit tighter than that. All right, so guys, take advantage of this 2-for-1. It's a great deal. I mean, for night, you guys are going to spend more than $90 going out to dinner for New Year's. This is the only thing that you guys can really do to increase your probabilities of success and everything else, is to pound information into that gray matter, that 6 inches of gray matter between your ears. And you know, the greatest traders are the ones that are constantly educating themselves, constantly looking for better ways to trade, which is what I do too. I mean, I go and watch other people's videos, and when I'm a part of these forums and stuff like that, I listen to what these other guys are saying, because we can all take something away from it. It's all worth knowing for sure. All right. Have a happy new year. Next time I see you, it'll be 2017 or talk to you guys. So have a great new year. Stay safe, and great trading. Bushels of wealth to you guys. Take care.